Okay, so picking up this lecture from where we kind of left off in class, um, we're talking about now making these inventory cost flow assumptions. So in all cases when we're not specifically attaching and tracking or able to track and tracking the actual items of inventory that are coming and going, in those cases we are going to make some inventory cost flow assumptions, and that's where the terminology FIFO, LIFO, weighted average, and of course specific identification is what we're talking about. Anything that's not specifically identifiable, which would use specific identification, but if it's not feasible or cost efficient to specifically identify each piece of inventory, then we're going to categorize it. So again, when we're talking about that, the purchases, the number of purchases and the cost per unit that we purchase for each of those batches, like you see here in the January 17th, March 22nd, October 15th purchases, those will be the same no matter what cost flow assumptions we're using. What we're talking about is down here under the sales, you see units down there under the bottom half of this slide. You see sales, date of sale, and units, right? And to each of those units we have to assign costs. Well, since we have a number of different levels of costs, we have a $6 level, $7 level, $7.50 level. We've got these three different levels of costs all within our inventory. Unless we're actually picking, and let's say we have these divided into 3 bins, and we're just picking out of each bin and tracking which unit we're picking out, and okay, that's from the $6 bin, we'll charge that as $6 cost to us. Well, that's a pain in the butt to have to group them together into bins like that, especially if they're all the very same item and kind of interchangeable. It doesn't make sense to have to, especially when we're talking about having, instead of 3 different levels of cost, if you had like 30 different levels of cost, then you can see how that would be a bit cumbersome to track. So instead of actually tracking each item, we just basically dump them all into a bin, and we've obviously kept track of how much they cost, and we know that we have a certain number of units that cost $6, a certain number that cost $7, etc., etc. And we can essentially, as we sell items, instead of actually paying attention to which item we're selling, we can assign up to 3,000 of our sales the cost of $7.50. And up to 3,000 of our sales, we can assign the cost of $7 per unit. And up to 1,000 units of our sales, we can assign $6 per unit. So depending on which cost flow assumptions we're using, those will determine which units we use first, in which order. If we end up selling all of these units in one transaction, it doesn't matter which one of these cost flow assumptions we're using, because we end up selling all the units. And at the end of the day, the difference between these methods of FIFO, LIFO, weighted average, specific identification, those are only different in the short term. Because in the long term, all of these costs here will eventually flow through to cost of goods sold. Currently, after we make the purchases, they all sit in inventory. The only difference is if we don't end up selling them all before the end of the year, we will have some costs still sitting in inventory and some of these costs assigned to cost of goods sold, and depending on which method we chose, the amounts in each of those categories, either inventory or cost of goods sold, will change until such a time as we sell off all the inventory, at which point we will have used up all of our costs, and all of those will have flown through or flowed through to cost of goods sold. units available is obviously beginning inventory plus any purchases that we make, and we are going to make sure that when we track those, we are keeping track of them in their various cost categories. Cost of goods available for sale, the total of beginning inventory plus purchases. That is going to give us the total amount that we could conceivably allocate from, that's what should be sitting in inventory, and that's the amount we can conceivably allocate to cost of goods sold this period. And whatever the case may be, a certain percentage of this will be allocated to cost of goods sold, and whatever's left should still be in the inventory account. Specific identification is, like we said, if we are actually tracking exactly which item we sell on which day, and that item has a label on it that says this one costs you $6. Then we will say, okay, we sold the $6 unit today. Obviously, if we're talking in the tens of thousands or hundreds of thousands or millions of units of all the very same item, think like blue Lego blocks or something, how many of those they sell every day or every month or whatever. Putting a little label on each identical little 4-block piece of blue Lego would be incredibly expensive, and the labels would probably cost more than it, or as much or similar to the cost of the unit itself. So obviously that would be ridiculous to do something like that. But for some items like, very custom autos or something where you sell maybe 3 of them a year and each of them costs, custom luxury supercars that each cost $2 million a year, obviously it's not going to be too hard for you to know exactly which car you sold on which date. So there are scenarios that it makes sense to use, but the differences and the difficulties arise in these scenarios where instead of tracking each individual item, we're going to apply these assumptions to the scenario, and basically, like I said, we will track and keep track of the costs of these various pools of inventory, and based on whichever assumption we use, we will assign pieces of those costs as inventory gets sold and that flows over to cost of goods sold. So under the average cost method, we basically are going to look at whatever units we have available for sale at any given time, divide that by their total costs, and that will give us our cost per unit at that time period. Then anytime we go and add more inventory, we will recalculate the average, adding the new inventory in and averaging that together with what we already have sitting in there. And so after each purchase, there is a new weighted average, and that weighted average cost is going to be a cost per unit, and that cost per unit will be used anytime sales are made until, so you get a purchase, you recalculate the average. Any sale that's made at that point, you use that average as your cost until such a time as you add more inventory, in which case you recalculate the average and go on using it that way. Under periodic, you don't take that average until the very end of the period, and at that point you would take an overall average of inventory added during the period, and then you would apply that based on the number of units sold during the period. But again, like I said, perpetual is more of what we're interested in here. So under perpetual, each time we add new inventory, we will recalculate the average that's there. So first inventory purchase right here, obviously no average needed because there's only one set of costs. Of that, we sold 2,000 units, and that was from that 550. Okay, so we have 2,000 left at that price point. We add another 1,000 at $6 per unit. and so we average this with the new units that we brought in. So we're adding the total costs there, total units, and divide, and that gives us a new average cost of 5,667 per unit. Then we bought some more, and so we're going to recalculate again. Since we didn't make any sales, we never actually used this average. We recalculated again with the new purchase, and we got 633 per unit. And after that average, we came back and sold 1,500 more units, and we applied that cost per unit. So you can see how that goes. FIFO, obviously, first in, first out. So we will track as units come in, the oldest, whatever, we will keep chronological order of our inventory, and the costs that we have on our books that are the oldest, those will be the first to be applied to our cost of goods sold. Now for FIFO, it doesn't matter if we use periodic or perpetual, because under either method we come up with the same results. And you can see why that would be the way that it is, since if we're always using the oldest inventory that's sitting there first, it doesn't matter if we keep track as we go or we wait until the very end. Each transaction will still be pulling the oldest inventory on the books as the first to go out. Now, that's not true for LIFO, so or weighted average, so it does make a difference to remember that under FIFO, the periodic and perpetual will yield the same results. Okay, under LIFO, obviously, since we're doing the very same thing, but we're going from the opposite direction, so last in, first out, and that is definitely going to make a difference whether we start drawing out inventory that's the oldest, whether we wait until the very end of the period to start making those draws, at which point we would start at the oldest for the year and work back from there, and likely not even touch a lot of the stuff that came out during the beginning of the year. Now, if we update as we go, let's see, get a good idea. Okay, here's it's going to be different under periodic versus perpetual, but let's look at why. Okay, so let me make sure I've got this next. Okay, sorry, I just couldn't remember which slides were still in this. Okay, so under perpetual, basically, yes, we're still going to take the oldest inventory first, but if you look at this, for instance, these 2,000 units that were sold on January 10th, well, those are pulling from our very first beginning inventory, right? But if we waited until the end of the period, then those 2,000 units, those would apply first to our very oldest inventory. So those would be this last group of 3,000 that was purchased. These 2,000 units from the January 10th purchase would actually first come out of that grouping, because if we're waiting until December 31st, we line all the purchases up and we take the newest stuff first, then we're going to look at the October 15th purchases as the very first that get put into cost of goods sold. So you can see if we're applying the perpetual system and updating with each purchase, pulling from the oldest at that point instead of waiting until the end of the year, you can see that we're hitting a lot of the older inventory sooner by using the perpetual system versus periodic. Now, when comparing the three generally, what you're going to see is, well, all three of them should yield the same totals here, because really that's all you're talking about is how do you allocate the cost in between inventory and cost of goods sold. So if they don't yield the same total, it should at least be close, in which case it would be a rounding error probably. If it's not even close, then you made some kind of mistake in your calculations. But what typically happens is you see there, assuming that costs have either steadily gone up or down during the period, then average would yield somewhere in between FIFO and LIFO for both cost of goods sold and ending inventory. There are some wonky situations that come up if you've had a period where costs have gone up and then gone back down and gone back up, all within the same period. That could throw off your averages to the point where average could actually sit at a lower or higher point for cost of goods sold or ending inventory than either of the other two. But that is the exception to the rule. Almost always the average is going to come down in between FIFO and LIFO, and that should make sense. So the norm, of course, would be during periods of rising costs, as inflation is the norm, and that's where costs are constantly rising. So during those times, FIFO will result in a lower cost of goods sold and a higher amount of costs still stored in ending inventory than LIFO would. And obviously, weighted average, again, assuming that that is a steady trend, either up or down, would be somewhere in between. And then the opposite would be true, obviously, if costs were declining, then the older inventory coming out first would actually yield a higher cost of goods sold and lower dollar value still sitting within the inventory account. FIFO, LIFO, and weighted average are all permissible under GAAP. And many companies, you'll see, don't actually use the same method for all inventory. So they may have it divided by country. So, you know, if different countries, IFRS actually has different laws. The international standards are different as far as what they allow versus U.S. GAAP. So you may have in the U.S. one method, abroad, inventory abroad measured a different way, or you may have just different classifications of inventory where you're a big company that has different types of businesses or different types of inventory, and it makes sense for whatever reason for you to track your inventory differently for different methods. Now, the key to remember there is barring some provable, essentially, extenuating circumstances, whatever method you choose at the outset has to be the method that you keep for the duration of your company. Now, obviously, it is allowed if there is some legitimate business purpose for later on changing, and obviously, if you did change to a different method, that would need to be disclosed in the financial statements. It's just an illustration of percentage of big companies that use these different methods of accounting or cost flow methods for inventory accounting. And you can see that obviously FIFO is the most common, and part of that is the IFRS discouragement of LIFO usage, and part of that is just some companies splitting up how they keep track of things. Yeah, these are some of the what's the word I'm looking for? These are some of the considerations that a decision maker would have to look at and would be weighing when initially making the decision as to which method to use. Theoretically, these are assuming, of course, well, these are the considerations that, depending on which way you went, that could affect essentially, what am I trying to say? These different categories can kind of weigh together to influence a particular outcome. So a decision maker can formulate the cost flow assumptions, depreciation method, pension assumptions. These are all choices the decision maker is allowed to make, and there are obviously some other choices as well. And you're going to kind of take the benefits of each of these categories, in deciding and weigh them against each other, compare them, how they interplay with each other, and whatever particular goal you're trying to reach. We'll assume generally the profit maximization of a company in the long term is the goal, but realistically these could be, a CEO could be looking at short-term incentives in their contract that could potentially mean the difference in millions of dollars to the CEO, depending on which of these assumptions and methods that they choose. So there are some less than profit maximizing motivations that could be in play, depending on what's in various contracts of decision makers. Physical flow. There are obviously, you can think of like food industry obviously comes to mind first, but there are situations where it's very important that the items sitting in inventory go out first. Obsolescence being another one. If things go obsolete quickly in a tech industry or some other industry, important that you use up the oldest inventory first, or it's going to be essentially either gone bad physically in the case of food, or obsolete in the case of outdated technology. Either case, it makes a lot of sense to get rid of older inventory first. Now, obviously, actual inventory you're getting rid of doesn't necessarily have to coincide with the way that you're tracking it from a cost assumption standpoint. But if there's no reason not to, generally it makes sense and is an easier sell from the accounting standpoint to say we're going to go with the similar way that we actually sell these products, in which we are getting rid of the oldest stuff first. Obviously, net income is a double-edged sword. The higher the net income, the more pleased stockholders are, but also the more pleased Uncle Sam is, because taxes end up being more as well. So depending on what short-term, long-term goals are, there are periods where a manager may be incentivized to minimize net income for the year so that taxes are lower. In periods where we expect our tax rate to be lower in the future, we may want to defer income into the future, and so that can be accomplished, at least in the short term, by selecting one or the other of these methods. And obviously, since net income and income taxes are very closely related, taxable income is not exactly net income, but it's closely related. So if we're wanting to maximize net income, we're also needing to think of what we're going to do to minimize taxes and/or avoid paying the penalty for maximizing taxable income as well. Like I mentioned, under IFRS, LIFO is not acceptable. That's actually one of the big sticking points between U.S. GAAP and IFRS. Like I said, what that often leads to is these big multinational companies disclosing it or using several cost flow assumptions based on what they have internationally versus what they have in the local or domestic warehouse. But also, this is just a sticking point in convergence of U.S. GAAP and IFRS trying to converge and become one. This is just a disclosure statement, in part showing how Rite Aid attracts inventory, and that's as far as we're going for this slideshow.